Good afternoon, and welcome to the AFS Best Practices Leadership Webinar. This webinar will be approximately an hour long, and our speakers today are Don Dougherty, Jeremy Charlson, and Rob Lynch. Before we get started, there are just a few reminders. We do encourage questions. Please use the Q&A feature to ask your questions. We will leave time at the end of our prepared remarks to answer as many questions as possible. We are recording today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Thank you for joining us today. Don?
Thank you, Renee. Hello, everyone, and welcome to our webinar, Pricing Fundamentals, a review of the fourth quarter 2022 commercial lending landscape. We here at AFS know how busy all of you are, and as always, we really appreciate you taking the time to join us today. We certainly welcome any comments any of you may have on today's webinar. Our contact information is provided at the end of this presentation, so please do not hesitate to reach out to us. It is worth noting that the source of the data presented today is from the AFS pricing service. This database is the industry source of pricing trends for commercial lending. We provide our pricing data tailored to your bank's specific needs via dashboards, flat files, and webinars on a regular basis. Our database contains a robust offering of measures and dimensions, allowing banks to tailor the analysis to their own unique footprints and exposures. And our database has been independently verified to be regionally representative and statistically significant in identifying risk-return opportunities. Our database is also used to prepare the AFS Commercial Loan Pricing Trends monthly newsletter. Please reach out to us if you are interested in receiving our monthly newsletter or if you are interested in learning more about our pricing service. On slide 4 is our agenda, which continues to be influenced by our customers and all of you. There is a survey following today's presentation, and we encourage everyone listening today to share your thoughts on items you would like us to highlight in upcoming webinars. Today's agenda includes a brief economic overview with a look into some of the macroeconomic indicators closely associated with commercial loan growth. Next, we will focus on the current trends in commercial loan growth and deal flow. And to round out today's agenda, we will present the recent trends in commercial loan pricing, spreads, and fees. And now, to get us started with the economic overview, I'll turn it over to Jeremy Charlson. Jeremy?
Great, thank you, Don. And Renee, we can go to the next slide, please. So I'd like to level set today with a look at some of the core economic drivers of commercial loan growth. 2022, in many ways, was a year of transition. Specifically a transition to an economy that could no longer depend on low interest rates to fuel economic expansion. Now, there were many negative headlines this past year, some saying that a recession was imminent, others believing the economy had already faltered into recession. But as of this writing, the US economy is still powering along. If you look on the far left there, we plot the trend in real GDP growth, which is an indicator we like to track as kind of a leading metric for commercial loan growth. When that ticks up, usually a quarter following that, we also see an increase in loan balances. In 4Q, real GDP expanded 2.9%, which was a better than expected result, and actually the second consecutive quarter of increase. And what's fueling that growth is primarily consumer spending, which is still robust in the face of high inflation. The labor market, too, has also been resilient. As shown by the middle graph, we gained 223,000 new jobs in December. And while that was the lowest level of the past year, to put that number into context, it's more than double the 100,000 increase that economists say the Fed needs to see in order to feel secure that inflation is cooling. From the Fed's perspective, the latest GDP and job reports likely mean that more rate hikes are needed in 2023. In fact, on Wednesday, the Federal Reserve raised its benchmark interest rate by 1/4 percentage point. And while Fed Chair Powell said, and I quote, "The disinflationary process has started," the Fed gave little indication that it's nearing the end of its rate hiking cycle. Inflation, as one commentator put it, is still very much the boogeyman, and we can see on the far right chart that while core inflation did indeed moderate in December, it's still far from consistent with the Fed's target. In terms of economic loan growth and commercial loan growth for that matter, I think a lot will depend on how quickly inflation fades, and if it doesn't, whether consumer spending and business investment will begin to peter out. But for now, there is still some steam left in the economic expansion, and thus there are still some good business lending opportunities out there. So in terms of loan growth, we're starting to see a divergence among banks in terms of strategy. Some banks are looking to take advantage of the growth momentum still left in the industry, while others are prioritizing optimizing spread and fee levels, even if that comes at the expense of higher loan growth. For now, the industry as a whole seems to favor the former strategy, as C&I loan growth was actually pretty robust at year end. The chart here examines C&I loan growth over the last year, where each month is indexed relative to December 2019 levels. So the idea is to see not only the recent trend in loan growth, but also how far we've recovered since the onset of the pandemic. In 2022, the C&I loan market has more than made up for lost ground in 2020. During the first half of the year, first half of 2022, that is in particular, growth in C&I balances was exceptionally robust as companies rushed to borrow before inflation and credit costs rose too extensively. Higher interest rates did take a bite out of loan growth in the third quarter, but total industry lending resumed at a strong pace in 4Q. Part of that growth in 4Q is seasonal. We almost always see balances increase at year end, but part of this increase reflects the continued strength of the US economy that we highlighted on the previous slide. With that said, I think as the year unfolds, banks will become increasingly more selective about where they lend and how they price. This is evidenced by the latest Senior Loan Officer Opinion Survey, which suggests that banks right now are at best cautiously optimistic about lending opportunities. But for now, looking at the growth trend, the credit and lending cycle hasn't turned a negative corner just yet. So here we take a more granular look at, here we present a similar perspective on CRE loan growth trends, so trends for the commercial real estate market. Loan growth for the overall CRE market, which is the left-hand picture here, had a good year in 2022, as did construction lending shown by the middle graph. But what really caught my eye this last quarter is the trend for multifamily on the far right. Multifamily registered an especially large spike in balances this December. Multifamily does have a reputation for operating well through market corrections, should we experience one in 2023. Basically, what happens is that inflation drives more people to rent, driving up demand for multifamily developers and operators. In fact, in today's rising interest rate environment, rent growth is to some degree counterbalancing the trend in interest rates. A concern in the CRE space, and it's probably not too surprising to hear this, is loans backed by office properties. The amount of office space listed for sublease is on the rise again, and with hybrid working models, there may not be enough tenants to absorb all these spaces. I believe I've also read that just 8% of Manhattan workers have returned to the office full time. So these back to office trends really are complicating the outlook for the office property type. So definitely some mixed forces driving loan growth trends in the CRE space. I'd expect multifamily to stay pretty strong, but as office really becomes harder to predict, I think that's going to start to have an effect on overall CRE loan growth. Now, one of the metrics we track both in connection to commercial loan growth and commercial loan pricing is the yield spread between a BBB corporate bond and the 10-year treasury. This metric widens when economic conditions worsen and investors demand a higher spread over a risk-free asset. The spread here narrowed in the fourth quarter as the market distilled the favorable economic report. However, the spread is up significantly in December when compared to the previous year. This means that capital market financing is not quite as attractive for some corporates as it was just a year earlier. Now, this can actually be a good thing for banks when it comes to loan growth. When bond and capital markets are less accommodating, companies are less likely to refinance bank loans in the bond market. Now, this is a dynamic that primarily influences the larger end borrowers, those with access to capital markets. But as we'll see, much of the recent uptick in commercial loan growth is being driven by the larger corporates. So here we take a more granular look at C&I loan growth across different segments of the market. On the left, we look at loan growth rates for bilateral loans versus participations and syndications, both indexed at December 2021 levels. We can see here that bilateral loan growth accelerated during the first half of the year, but then sort of leveled off during the second half. By comparison, growth in the syndicated market was far more robust this year, with participations and syndications expanding for the full year at more than twice the rate seen for bilateral loans. Note that the average loan size in the syndicated market is larger than that for bilateral loans. When we focus on the bilateral loan market, we see a similar dynamic in terms of large versus small deals. As you can see on the right-hand picture, much of the bilateral loan growth for both the month of December and the entire year was focused in the larger end loans, those over $10 million in size. In fact, bilateral loans under $3 million were down for the year. I mentioned on the previous slide that less accommodating capital markets have made bank loans more attractive for corporate borrowers. And I think that's why we're seeing the acceleration here in syndicated credit and larger end bilateral loans. As far as the contraction in the smaller end of the market, that decline we're seeing in the blue series for less than $3 million, I think two things are going on here. First, according to the latest Senior Loan Officer Opinion Survey, banks continue to tighten lending standards, which impacts first and foremost the smaller, riskier borrowers. Second, non-banks, which are subject to less regulatory scrutiny, continue to gain market share in the SME and lower middle market space. Looking ahead, I expect many of these same trends and market forces to continue in 2023. So over the next few slides, we continue to disaggregate loan growth trends, this time by geographic area. The metros you see here are the top 10 core-based statistical areas in terms of population. What we found is that historically, larger areas generate faster rates of commercial loan growth. I guess the theory being that if it's a larger market, more economic activity, it can absorb credit or sustain loan demand more extensively than the smaller markets. For the latest quarter, and this is a quarter-over-quarter picture in growth rates for C&I and CRE loans, Philadelphia reported the greatest increase in C&I balances. You can see that big blue spike near the right-hand side of this particular chart. When I drilled into the details here, I noticed that telecom was one of the industries fueling Philadelphia's increase. Some metros like Atlanta, Chicago, Los Angeles, and Phoenix offset declines in C&I balances with high levels of CRE lending. You can see, for example, Atlanta, second from the left there, it had a decline in C&I lending, but a fairly sizable increase in commercial real estate borrowing. Now, the variation in growth rates across these metros is very wide, and it's pretty much consistent with what we've observed in prior quarters. We typically observe a wide disparity among CBSA growth rates in nearly every quarter that we examined over the last year. Economic activity, populations, and industry concentration, all of these kind of factors can greatly influence a given metro's capacity to absorb credit. So here on the next slide, we dissect loan growth by several major industry exposures. A big winner this quarter and this past year in terms of total balance growth has been the manufacturing sector. I was actually a bit surprised to see that, given that capacity utilization for the overall industry has been trending downwards. But I think it's a good trend. I think it could mean that supply chains are starting to return to, at least get back to normal. after a very volatile and frustrating previous year. For manufacturing, growth in this industry has come from beverage and tobacco manufacturing, as well as what you might call higher types of manufacturing, like those focused on computers and chemicals. Balances also spiked in recent months for the information technology sector, which is the second industry here. That represents primarily telecom and data processing. The middle industry on this picture, finance and insurance, presented the most interesting trend to me. In previous years, finance and insurance was by far the leading sector for total commercial balance growth. Borrowers in this sector include asset managers and private equity firms that borrow from banks to increase their dry powder, meaning the funds they use to acquire assets and lend out to their own clients. Rising rates pose heightened risks to finance and insurance companies, since they often lend to riskier clients that have strained debt service coverage, even during periods of low rates. We mentioned earlier that banks are becoming more selective about lending opportunities, and I think the tepid growth rates we see here for finance and insurance might be one example of that. A similar thought process could be affecting the downtrend on the far right for accommodation and food, in which banks are worried about this sector being one of the first to tip in this challenging environment of high interest rates and high inflation. When it comes to loan growth, many of the questions we get center on line of credit utilization. As some context, back during the onset of the pandemic, utilization spiked as customers drew heavily on lines of credit to shore up cash. When measures to control the spread of COVID-19 essentially shut down many sectors of the economy, line utilization fell well below levels consistent with the historical norm. Thankfully, as of December, line utilization has largely recovered from the pandemic retrenchment, particularly for C&I loans. As of December, C&I line utilization was in line with the pre-pandemic average and up significantly year over year. Now, CRE utilization in the pink series, that's been a bit more challenged this year. It fell both quarter over quarter and year over year. We should note that the majority of lines of credit for CRE are for construction projects. And what we're hearing from banks is that utilization is down because in some cases, projects no longer make economic sense with high interest rates. Moreover, the number of new houses being bought is trended downwards, again due to high interest rates. Most banks have a limit on the number of spec houses that can be built. So with nobody buying, builders aren't making any new houses builders aren't making any new houses that aren't already sold. Consequently, these forces are depressing the line utilization rate for the commercial real estate market. Now, when you think of line utilization, say in the retail space, higher utilization rates are often associated with riskier borrowers. The same can be true for commercial loan borrowers, perhaps not quite to the same extent, but the basic relationship holds true. So keeping with that idea, here we compare utilization rates against weighted average risk ratings across every NAICS sector in the database. In general, sectors with higher or worse weighted average risk ratings, the x-axes here, have higher utilization rates, the y-axes. There are some sectors that stray from this relationship. In the top left corner, we have a handful of sectors where line utilization is high and weighted average risk rating is favorable. These are what you might call overweighted sectors, the term that's appropriate here, meaning they offer high growth without taking on high risk. Notably, the information technology sector falls within this quadrant, NAICS 51, as does, somewhat surprisingly, NAICS 52 finance and insurance, which we already mentioned as being an industry that is somewhat rate sensitive. Other industries, such as healthcare in the lower right quadrant, display low utilization rates and comparatively unfavorable risk ratings, the exact opposite type of profile. Healthcare has faced several headwinds in recent months. In particular, nursing care facilities in many areas of the country have high vacancy rates, and we've heard reports that urgent care centers have been overbuilt in some metros. Looking at industries on a risk return plane like this is always helpful, particularly again as banks become more selective on growth opportunities and where they target their new lending. So in terms of loan growth, economic fundamentals are still solid and line utilization rates have largely returned to pre-pandemic levels. Banks too continue to highlight strong loan pipelines in earnings calls, which we see here reflected in new and renewed volume trends. So here we look at new renewed volume over the last couple of years with the trends for C&I loans up top and the pictures for commercial real estate loans on the bottom. What you might first notice on these charts is that the spike in December 2021 in new volume for both C&I and CRE loans. You can see that spike on the left-hand charts there. While December is generally a strong month, the uptick in December 2021 was extraordinarily large. This was when inflation was really starting to ramp up and borrowers became more anxious about rising credit costs. Perhaps the biggest takeaway, though, is that for every picture, the overall trend line over the last 2 years is positive. This again indicates that loan pipelines are strong and that there's still some growth momentum left in the industry. It'll be interesting to see how the slope evolves in 2023. If inflation remains high and consumer spending deteriorates, then commercial borrowers or potential borrowers may become more hesitant about taking on additional debt. And so we wanted to conclude this section by examining the risk composition of new renewed volume in order to see if there's any cracks emerging in terms of credit quality. For C&I loans on the left, the distribution displays modest fluctuations over time. Year over year, there really wasn't much change other than a slight transition from the percentage of volume rated pass to low pass. It's a different story though for CRE loans on the right-hand picture. The percentage of new renewed CRE volume rated investment grade was down sharply year over year, with a corresponding increase in low pass volume. Now, I don't think what's going on is that banks are loosening standards and going after riskier CRE deals. Rather, I think the opposite is occurring. Banks are becoming more conservative in how they underwrite and risk rate CRE credit, resulting in fewer loans meeting the investment grade threshold. There are definitely some headwinds in the CRE space, specifically for loans backed by office properties, and I imagine bank conservatism will increase in 2023 when booking new CRE deals. So in summary, the economy for now is still on solid footing, and while some banks are looking to maximize these growth opportunities, others are pivoting to focusing on optimizing spread and fee levels. For a deeper look at trends in recent C&I and CRE loan pricing, I now turn the presentation over to Rob Lynch.
Thank you, Jeremy. Good afternoon, everyone. I want to start by looking at interest rates overall. So on slide 18, we show interest rates on commercial loans have increased dramatically this year as the Fed has increased rates. Specifically on C&I loans in the left-hand chart, you can see that investment grade and non-investment grade loans have followed similar paths. The difference between investment grade and non-investment grade was over 100 basis points at the start of the year, and in December, that difference dropped to 55 basis points. Interest rates on investment grade CRE loans in the right-hand chart have increased at a quicker pace over the last half of the year than non-investment grade. The difference between those two groups in December is now just 20 basis points. On the next slide, we show a distribution of balances between the various indexes. C&I new and renewed balances show SOFR being the first choice index for floating rate lending, while both prime and fixed base lending showed small declines. A similar picture is shown for the CRE balances in the bottom two charts, where SOFR is far and away the predominant choice. Also of note is that fixed-based and prime-based lending made modest increases from a year ago. On the next slide, we examine what has happened with those loans that were renewed from a LIBOR index base to a SOFR index base. Over the last 9 months, more than 50% of LIBOR loans transitioning to SOFR had an increase in spread. and in the fourth quarter, that increase grew to the largest level seen over the year, and we're at a high of 28 basis points in December. Next, we break out SOFR loans by risk groupings. In the higher groupings, namely investment grade and pass, we can see no change in spreads from the third quarter. The lower risk grades are where there was more volatility over the quarter. The finance and insurance industry was a key driver for this volatility. For CRE loans, we see that in all risk groupings except speculative, the spreads increased in the first quarter by modest amounts. Next, on the next slide, we focus on new and renewed prime-based loans. In the top chart, we can see that spreads had small positive and negative movements in the investment grade, pass, and low pass risk groupings, whereas there was a large increase in spread in the speculative risk rating. This large increase was due to loans made in the healthcare sector. And for CRE prime-based loans, shown in the lower chart, spreads were slightly higher in all risk groupings except for low pass, where a number of banks reported lower spreads this quarter compared to last. Next, we'll look at fixed rate loans. Here in the left-hand chart, we see that interest rates on fixed C&I loans in December increased the most for the shorter durations. It is also interesting that with the exception of the 5 to 10 year duration, these rates are in a tight range. In the right-hand chart, we show CRE fixed rate loans, and we see a similar trend, namely that interest rates rose the most over the past year for the shorter term duration loans. Next, we'll show pricing across the country. You can view this slide as a heat map to see where interest rates are in the various states. And as you can see, all but 3 states have average prices greater than 500 basis points. The states with the highest interest rates are located in the Southwest and Northeast primarily. On a quarter-over-quarter basis, most states, interest rates rose by 100 basis points or more, reflecting the Fed rate hikes. On the next chart, we'll look at spreads for selective competitive CBSAs. On this chart, we focus the data to SOFR-based non-investment grade loans to illustrate that there can be wide variations in pricing within the same geographic areas. A market such as Dallas-Fort Worth shows a very tight range in spreads, indicating a competitive environment. Contrast that with Chicago or Denver, where the top quartile is more removed from the median, indicating potentially more room to negotiate pricing. The pricing service can help banks uncover these types of dynamics in their local markets and provide valuable assistance to pricing decisions. Next, we highlight the year-over-year change in SOFR spreads by industry. Although the overall change for all industries is negligible, an increase of 2 basis points shown by the first bar on the left, when looking at specific industries, we can see quite a lot of variability. Agriculture, transportation, information, and leisure all had significant increases in spread, while mining, oil and gas, manufacturing, and administrative support and waste management saw large decreases. The pricing service can help banks understand how their industry composition can affect overall spreads and profitability. Turning next to fees, we see this chart shows a trend of upfront fee incidence depicted by the blue line and upfront fee level depicted by the orange line. The last 3 months of 2022 saw a steady, small increase in fee incidence, and December saw the highest level of incidence seen over the last 13 months. In December, fee level, the orange line, was near the highest level seen over the last year. Typically, we see an inverse relationship between these metrics, but clearly there seems to be a renewed emphasis from banks to include these fees in their deals. The next chart provides a deeper look at upfront fee level by segmenting the data by commitment size. On this slide, the left-hand chart shows the upfront fee level and the right-hand chart shows upfront fee incidence. On both charts, we plot the average, shown by the blue dot, and the range in each deal size category, represented by the lines. The smallest size range shows the highest average fee level, while the average for the remaining deal size ranges are in a tight band. Fee incidence in the right-hand chart highlights that fees on the larger size deals, those $5 million and greater, are much harder to come by with an average well below the other deal sizes. Last, we take a look at unused fees, an important revenue driver for banks. On this chart, we are showing, we are showing the larger deal sizes, and you can see the fee level between the $5 million and $25 million bucket and the greater than $25 million deal sizes is not all that much different. In the right-hand chart, however, we see that banks are more likely to charge this fee on the largest deals in an effort to earn some return on the undrawn portion of commitments, thereby compensating the banks for their capital requirements on these larger deals. Next, we'd like to conclude this webinar by showing you an example of how we deliver data and information to clients participating in our pricing service. The sample report here is a flat file delivery we call the pricing guidance file, which provides insights into various combinations of market characteristics. The report lists all the new, renewed transactions for the sample bank down the rows and the indicative characteristics and measures of pricing across the columns. Using this file, you can quickly filter for all of the loans in a particular line of business or industry. What's special about this file is that for each bank loan, we append a market equivalent rate, spread, and fee level based on market loans that share the same indicative characteristics, such as industry, geographic location, and risk rating. You can then array the loans by their difference from the market observations to quantify areas of strength and opportunity. That's what we have pictured here with the bar graph. You can then see whether the pricing outliers are concentrated in a particular segment and address them accordingly. The report is fully customizable. We can present the data at an obligation level or a segment level depending on your preference. The file format also is easily consumed into a data mart or data warehouse for additional analytics at your bank. That concludes today's presentation, and I'll turn it back over to Renee, who's been tracking the questions you may have. Renee?
Thanks, Rob. So we'd like to thank Rob, Jeremy, and Don for their remarks today. Hopefully you all found it informative. As we mentioned, we will be sending out a link for you to be able to listen to this webinar again or share with a colleague. And we are hoping there are some questions. So if you do have questions, if you could type those into the chat area or to the Q&A, we'd appreciate that. And we'll take a few minutes to let you put your thoughts together, and we'll answer those as they come in. So we have a question here that someone has asked is, are you able to track ESG loans, balances, rates, prices, etc.?
Right, this is Jeremy. I'll take that question. That's a great question, Shane. A lot of banks right now are trying to understand, can we measure financed emissions in our portfolios? I know right now in Europe, there's actually stress testing that is asking banks to do just that. Measure their financed emissions, measure the sustainability impact they have with their lending. Right now in the US, it's been challenging to identify that exposure. We are starting to do some more work on the loan system side. AFS, our bread and butter business, is building loan accounting engines, and we're starting to do more work around trying to identify those loans. One thing, Shane, you might want to check out, the Bureau of Labor Statistics has put out a green industry hierarchy. It's sector-based, but it does allow you to kind of track your exposure in green industry verticals and green industry sectors. And maybe for the next webinar, we can use that hierarchy to actually look at, for the market, how much of the balances are falling into these quote-unquote green sectors. But it's a great question, and one that I think is going to evolve a lot more over the next few months.
Thank you, Jeremy. Looks like that was our only question for today. So I want to thank everybody for their attendance and attention. And as we said, we will be emailing out a link for this webinar. Thank you all and have a good day.